Most investors believe that to get rich, they need to pick the next hot stock, time the market perfectly, or follow complex financial models. The truth is exactly the opposite. History shows that the most reliable way to grow wealth is remarkably simple. Own the entire market, keep your costs low, and do almost nothing. That statement alone upends decades of conventional wisdom sold by brokers and financial influencers. Today, I will show you why obsessing over trades, chasing trends, and listening to financial noise is not just unnecessary, it is actively harmful. You will learn a method so simple that it feels almost lazy, yet it works more consistently than 95% of strategies used by the so-called experts. By the end of this video, the noise will fade, and you will see clearly what truly matters for building long-term wealth, without stress, without luck, and without guessing. This approach is not theory. It has been proven over decades through bull markets, bear markets, inflation, crashes, and recoveries. It is the quiet secret that almost no one in the investing world wants you to know, because simplicity does not sell. The first thing to understand is that investing is not about cleverness. It is not about having the latest insider tip or spotting the next hot trend before it becomes obvious. It is about discipline, patience, and the quiet power of broad ownership. John Bogle, the founder of Vanguard, spent his life demonstrating that the most successful investors are not those who chase complexity, but those who embrace simplicity. Consider the stock market as a vast machine, a mechanism that, over time, grows the economy and rewards those who participate fully and patiently. Trying to outsmart it in the short term is like trying to outrun the tide at the beach, exhausting, futile, and prone to disaster. The problem is that most people are taught to think of investing as a game of skill rather than a system of patience. We are bombarded by advice from every corner: financial news outlets, social media, friends, and even well-meaning family members. Each has a theory, a strategy, a tip that promises outsized gains, yet the historical record is unambiguous. Over decades, low-cost index funds capturing the full market have outperformed the vast majority of actively managed funds. It is not because the managers are incompetent. It is because the combined costs, friction, and human fallibility make consistently beating the market nearly impossible. The lesson is uncomfortable but liberating. You do not have to be smarter than everyone else. You just have to be disciplined and aligned with the market. To make this real, consider the impact of costs on long-term returns. Imagine two investors, both contributing the same amount every month over 40 years. One invests in a fund with a 1% annual fee, the other in a fund with a 102% fee. The difference seems small at first glance, but compounding transforms that small difference into a chasm. By the end of the 40-year period, the investor in the high-cost fund might have accumulated around $1.2 million, while the low-cost investor could have nearly $2.5 million. That is more than double, achieved not through skill, luck, or timing, but by simply minimizing costs and letting the market work for you. This is the kind of advantage that is invisible in the short term, but undeniable over decades. Now, let us talk about the psychology of overthinking. Human nature is wired to react to change. Volatility triggers stress, headlines provoke urgency, and every dip in the market tempts us to act. Yet the very actions that feel like control-switching funds, chasing returns, or timing entries and exits are often the exact behaviors that reduce long-term wealth. This is why intelligent people, even those who understand the principles of investing, often sabotage themselves. They know the right path, yet they fall prey to fear, greed, and the seductive allure of action. By embracing a simple, low-cost allocation, you remove the emotional pressure to make constant decisions, allowing compounding to do the heavy lifting. The essence of this strategy is deceptively simple: a broadly diversified portfolio of stocks and bonds, weighted in a way that aligns with your risk tolerance and maintained over decades. You do not need to know which technology company will dominate the next decade or which market segment will surge next quarter. You simply need to own a piece of everything. This is not a compromise or a lack of ambition. It is a proven path that magnifies patience and discipline while minimizing the chance of catastrophic errors. It is the difference between participating in the growth of the economy and gambling on the illusion of insider knowledge. Consider the historical perspective. In the 1970s, inflation ran rampant and stock markets were turbulent. Investors who tried to pick winners or follow trends found themselves whipsawed by volatility. Yet those who held broad, low-cost index funds captured the long-term growth that persisted beyond the short-term chaos. In the 1980s, during a sustained bull market, the same principle applied. The investors who stayed invested steadily grew their wealth without stress or drama. Fast forward to the 2000 dot-com crash, and we see the same lesson reinforced. Those who chased speculative tech stocks suffered massive losses, while those with diversified, disciplined portfolios remained on track. Across every market cycle, the same simple principle: broad ownership, low costs, and patience delivered results. Another dimension is the temptation of novelty. Every few years, a new investing strategy emerges, promising higher returns with clever timing, exotic instruments, or algorithmic edge. The market industry thrives on these stories because they exploit our cognitive biases. We believe complexity signals intelligence, and we overestimate our ability to act rationally. Yet the evidence repeatedly shows that embracing novelty without understanding its risks often leads to disappointment. Simplicity, in contrast, requires courage. It demands resisting the urge to act, resisting the allure of complexity, and trusting in a system proven over decades. This is counterintuitive, which is why it is so powerful. The paradox of investing is that less action often produces more results. While our instincts scream that constant adjustment is necessary, the disciplined investor knows that a patient, steady approach compounds advantage over decades. The power of compounding is not just mathematical, it is psychological. Each decision avoided each panic-driven trade. You resist a diss to your long-term wealth. The quiet victory of simplicity is that it aligns with human behavior rather than fighting against it. Over time, this alignment creates not only financial gain, but also emotional freedom. By now, you may be asking, what exactly does this simple allocation look like? That question is natural, but it is not the first step. The principle matters more than the precise percentages because understanding the underlying logic protects you from chasing fads or following the herd. The allocation is effective precisely because it is a framework, a foundation that can be adjusted for age, risk tolerance, and goals without succumbing to complexity. The next parts of this video will reveal not only the allocation itself, but also how to apply it in a way that minimizes stress, maximizes discipline, and leverages decades of market history for ordinary investors. What I want you to take from this opening is not just curiosity, but clarity. Overthinking is the enemy of wealth. Complexity is the seduction that leads to mistakes. Costs are the silent killer of returns. And human nature will always push you toward action, often at the wrong time. Recognizing these truths is the first step toward mastering your financial life. The simple, disciplined approach we are about to explore does not promise excitement or instant gratification. It promises the reliable, slow, and compounding power that has created wealth for countless ordinary investors over decades. As we move deeper into understanding why simplicity works, it is crucial to examine the historical record in detail. Take, for instance, the market turbulence of the 1970s. Inflation soared into double digits, oil crises shocked economies, and stock markets swung wildly from month to month. Investors who tried to predict which sectors would outperform found themselves whipsawed by events beyond their control. Yet those who held a broad market index fund weathered the storm with steady growth over time. Their patience allowed them to capture the eventual recovery and the subsequent bull markets of the 1980s. This was not luck. It was the natural outcome of owning the entire market, minimizing costs, and resisting the temptation to act on every headline. The lesson is clear. Markets are unpredictable in the short term, but over decades, disciplined ownership of broad assets delivers results. Consider another example, the dot-com bubble of the late 1990s. Technology stocks were soaring, and almost every investor believed they could pick the next big winner. Brokers and analysts fueled the frenzy, creating a narrative that complexity and expertise were necessary to succeed. Yet, when the bubble burst in 2000, those chasing hot tech stocks suffered catastrophic losses. Meanwhile, investors with a diversified portfolio of stocks across sectors and geographies stayed the course. Over the following years, as the broader market recovered, these investors regained their losses and continued to grow their wealth steadily. The stark contrast highlights a pattern repeated countless times. Chasing complexity and timing often leads to pain, while disciplined, simple strategies prevail. This is where psychology plays a central role. Human behavior is the invisible force behind most investment mistakes. We are prone to recency bias, giving too much weight to recent events and assuming they will continue. We succumb to overconfidence, believing we can predict market movements that are inherently unpredictable. We experience loss aversion, reacting emotionally to declines even when long-term fundamentals remain strong. Understanding these tendencies is as important as understanding the markets themselves. They explain why intelligent and well-informed people repeatedly fail to follow even the simplest, most evidence-backed strategies. Imagine an investor in 2008 during the financial crisis. The markets were collapsing, banks were failing, and fear was pervasive. Many people sold their investments in panic, locking in massive losses. Others held their broad-based, low-cost portfolios, even as headlines screamed doom. The latter group benefited immensely over the next decade as the market recovered and reached new highs. The difference between these outcomes was not luck or secret knowledge. It was behavior discipline in the face of fear. This illustrates a timeless truth. Your own actions, more than market conditions, determine long-term investment success. To make this more relatable, consider the typical investor's day-to-day decision-making. Many spend hours reviewing financial news, obsessing over fund performance, and worrying about market fluctuations. This constant engagement creates stress, distraction, and often leads to poor choices. In contrast, the disciplined investor using a simple allocation strategy focuses on consistent contributions, rebalancing occasionally, and letting compounding do its work. Time, not talent, becomes the ally. The simplicity frees mental bandwidth, reduces anxiety, and allows investors to live their lives without being hostage to every market headline. Let us also examine the cost factor more rigorously. Fees are deceptively dangerous because they erode wealth slowly and invisibly. Imagine an investor paying 2% in annual fees versus one paying 0.2% for the same investment over 40 years. At first glance, the difference seems negligible. But when compounded annually, the higher-cost investor may end up with less than half the wealth of the lower-cost investor, despite earning the same market returns. This is not theory, it is arithmetic, and yet many investors continue to chase supposedly superior returns while ignoring the silent drain of costs. Low-cost, broad market investing neutralizes this threat, making compounding far more powerful. History also shows that diversification is indispensable. Owning a concentrated portfolio of a few stocks or a single sector exposes investors to idiosyncratic risks that can derail long-term plans. A broadly diversified portfolio smooths out volatility, allowing the investor to ride through bear markets and capture growth without panic. For example, during the 1970s, some industries suffered dramatic losses while others prospered. Those holding only a few sectors saw extreme swings, but diversified investors remained on track. The market, in effect, rewards patience and breadth over cleverness and narrow focus. Even the most rational investors struggle with emotional discipline. Studies consistently show that average investors underperform the funds they invest in because they buy high in moments of optimism and sell low in moments of fear. This pattern, repeated over decades, explains why simplicity and discipline are so powerful. By owning a broadly diversified low-cost portfolio and avoiding frequent trading, investors circumvent the psychological traps that lead to underperformance. In other words, the system is designed to work with human nature rather than against it. Another key point is the long horizon. The longer you stay invested in a simple, broad allocation, the more predictable and powerful the outcomes become. Short-term noise is overwhelming, but over 20, 30, or 40 years, the compounding effect of returns plus reinvested dividends transforms modest contributions into substantial wealth. Consider a young investor starting at age 25 with consistent contributions. By 65, even modest monthly investments could accumulate several $1,000,000, illustrating the extraordinary effect of patience combined with disciplined execution. Finally, the evidence underscores a critical truth. The simpler the strategy, the easier it is to execute consistently. Complexity invites mistakes. Simplicity invites success. Across every historical period, from stagflation in the 1970s to the financial crisis in 2008, investors who followed a simple, broad, and low-cost strategy consistently fared better than those chasing clever schemes. The takeaway is powerful. Wealth is not built by reacting to every market impulse or by crafting intricate plans. It is built by aligning your behavior with proven principles, minimizing costs, and giving compounding the time it needs to work. Many people resist the idea that simplicity is sufficient because it feels almost too easy, too passive. Surely I can do better, they tell themselves. I have the skills, the knowledge, the discipline. I just need the right strategy. This objection is natural. It is rooted in pride, in the desire to feel competent, in the belief that effort should be rewarded with superior results. Yet history and behavioral science tell us something uncomfortable. Most attempts to outperform the market fail. The odds are stacked, not against your intelligence, but against your ability to consistently act without emotional interference. Recognizing this is not defeat, it is clarity. It is seeing the playing field as it truly is, rather than as we wish it to be. Take, for example, the investors in the 1990s who believed that technology would redefine the economy and that they could pick the next Microsoft or Amazon. They were smart people, well-educated, diligent, and engaged. Yet, when the dot-com bubble burst, they experienced devastating losses. Conversely, investors who held broad, diversified portfolios were largely unscathed, benefiting instead from the long-term growth of the entire market. The lesson is that talent alone is no substitute for structural advantage. By minimizing fees, owning the full market, and avoiding unnecessary trades, you harness a structural advantage that is far more reliable than skill or intuition. Emotion plays an even larger role than intellect in determining outcomes. Humans are wired to react to fear and greed, and financial markets exploit these impulses. Panic selling during declines, exuberant buying during rallies, and constant attempts to time the market are natural behaviors, but they are also predictable mistakes. When you embrace simplicity, you remove much of the emotional stimulus that provokes these errors. A disciplined allocation with broad diversification does not need constant attention. It requires trust in the system and patience, which in turn minimizes costly emotional reactions. This is not a lack of ambition. It is a conscious strategy that prioritizes long-term results over short-term thrills. Real stories bring this lesson to life. Consider an investor who, in 2008, watched the financial system teeter on collapse. Tempted to sell everything, she held firm, guided by the principle of owning the entire market and keeping costs low. Over the next decade, her portfolio recovered and grew, transforming not just her financial situation, but her sense of security. Contrast that with her neighbor, equally intelligent and motivated, who liquidated investments at the bottom of the market, only to re-enter years later with diminished capital and lost opportunity. The difference was not intelligence, effort, or luck. It was adherence to a simple principle. Simplicity preserved wealth and, more importantly, preserved emotional stability during one of the most turbulent periods in financial history. Objections often also take the form of impatience. Some argue, I am young, I want to be aggressive, I want to take risks for higher returns. The truth is that age and risk tolerance can guide your allocation, but they do not negate the value of simplicity. A young investor with a higher stock allocation still benefits from a broad market approach, reinvested dividends, and low costs. Risk is controlled not by chasing complex strategies, but by diversification and discipline. Over decades, the compounding effect of even modest, steady growth exceeds the occasional triumph of high-risk bets, which are just as likely to lead to catastrophic losses. There is also the temptation to micro-optimize. Every year, a new trend appears. Artificial intelligence funds, thematic ETFs, or new financial instruments promising superior returns. While these are exciting, they often distract from the fundamentals. Most investors overestimate their ability to time these trends or select the best instruments. The historical record shows that the incremental gain from correctly timing novelty rarely compensates for the risks and costs incurred. Simplicity is not about ignoring innovation. It is about understanding that consistent exposure to the entire market held over time produces far greater results than chasing ephemeral fads. The emotional core of this lesson is profound. Overthinking and constant tinkering create stress, anxiety, and regret. The human cost of complexity is real: sleepless nights, strained relationships, and the constant fear that you are doing something wrong. By adopting a simple, disciplined strategy, you do more than grow wealth. You reclaim mental and emotional freedom. Financial life becomes a source of security rather than tension, a quiet foundation rather than a roller coaster of highs and lows. In this way, simplicity serves both a rational and emotional mind, aligning with human nature while respecting the long-term rules of the market. Let us also consider the lesson of compounding in an emotional context. Contributions made consistently over decades, reinvested dividends, and growth captured across all sectors accumulate silently but powerfully. The longer one waits, the more pronounced the advantage becomes. Complexity tempts us to interrupt this process, to interfere, to tinker, but each unnecessary decision risks undoing years of disciplined progress. Emotionally, resisting the urge to act is difficult, yet the payoff is extraordinary. Discipline transforms into freedom, patience transforms into wealth, and simplicity transforms anxiety into confidence. Finally, it is essential to understand that objections are not just intellectual, they are deeply personal. We want to believe we are capable of outperforming the market because it feels empowering, yet real empowerment comes from understanding the rules of the game and working within them. History, psychology, and mathematics converge on one conclusion: owning a broadly diversified, low-cost portfolio and holding it patiently is the path most likely to succeed. Challenging as it may be to resist the urge to act, it is far more rewarding in terms of both financial outcomes and emotional well-being than attempting to outsmart the system. The upshot is that the simplicity strategy is not about doing nothing, it is about doing the right thing and doing it consistently. It requires courage to ignore noise, discipline to maintain allocation, and patience to let compounding work over decades. By confronting objections head-on, pride, impatience, fear, and the allure of complexity, we see that the simple allocation strategy is not just adequate, it is optimal. The story is clear. Human nature pushes us toward mistakes. Yet a simple, evidence-backed system aligns behavior with favorable outcomes. In practice, this alignment creates the extraordinary result of consistent wealth accumulation and emotional resilience, a combination far more powerful than cleverness or luck. As we transition from understanding the emotional and psychological barriers to investing, we arrive at the practical clarity that simplicity brings. The core principle is elegantly straightforward. Own a broadly diversified portfolio, keep costs low, contribute consistently, and allow time to work its compounding magic. This is not a rigid formula. It is a mindset, a framework that guides every investment decision and shields you from the temptations of short-term thinking. The beauty of this approach lies in its alignment with human behavior. By reducing complexity, you remove emotional triggers that provoke impulsive choices, creating a space where rational, long-term thinking can prevail naturally. Consider the power of consistent contributions. Even small, regular investments accumulate substantially over decades. Imagine contributing a modest amount every month from age 25 to 65 into a broadly diversified portfolio. Over 40 years, compounded returns transform these modest contributions into a substantial nest egg. This principle demonstrates the quiet might of patience over brilliance. You do not need to make perfect calls or predict market trends. The mechanics of compounding and the discipline of consistency will carry your wealth forward, provided you avoid unnecessary interference and maintain a long-term perspective. A surprising insight often overlooked is the role of incremental cost differences. Many investors focus on potential returns, chasing the highest performing funds or trendy sectors, but overlook the hidden drag of fees. A mere 0.5% difference in annual costs may seem trivial, but compounded over decades, it can slash your wealth by millions. This is a subtle yet profoundly impactful principle. The lower your costs, the greater the power of compounding. Here lies one of the quietest forms of leverage in investing, not high-risk bets, but cost efficiency. Understanding this transforms the approach to portfolio selection from one of speculation to one of strategic optimization. Rebalancing is another element that embodies the practical wisdom of simplicity. Markets fluctuate and asset values drift from their intended allocation. Rebalancing periodically restores balance, ensuring that you maintain the risk profile suited to your goals and temperament. This practice is not about timing the market, predicting trends, or making actor bets. It is about maintaining discipline, reducing risk, and reinforcing the principle of steady, consistent growth. Each rebalancing decision, simple in execution, compounds over decades, preserving the alignment of your portfolio with your long-term objectives. Simplicity also extends to behavioral guidance. Avoiding frequent trades, resisting market noise, and not succumbing to hype are all actions that emerge naturally from a framework that emphasizes patience and discipline. For instance, when headlines scream about a sudden market crash or a new investment trend, the disciplined investor pauses rather than panics. This pause, though seemingly passive, prevents decisions that could undermine decades of accumulated wealth. The practical lesson is that simplicity is not laziness, it is active restraint, and informed patience that produces consistent results. Let us examine a concrete illustration. Imagine two investors both entering the market at the same time. One chases the latest funds, rotates sectors, and reacts to every news cycle. The other follows a simple, broad allocation, maintaining low-cost exposure and contributing consistently. Over decades, the first investor experiences higher stress, occasional gains, and frequent losses due to poor timing and costs. The second investor, while less reactive, steadily accumulates wealth, capturing the benefits of compounding and market growth. The contrast is instructive. Simplicity produces not just financial outcomes, but emotional stability and confidence that persist throughout life. Midway through the investment journey, a reframe can reignite engagement. Consider that small, seemingly insignificant choices, like selecting a fund with a 0.02% fee instead of 1%, can have dramatic long-term consequences. Over 40 years, this subtle shift transforms the portfolio's final value exponentially. It is not about chasing glamour or extraordinary returns. It is about understanding that compounding favors consistency, cost efficiency, and disciplined allocation. The insight is quietly revolutionary. By focusing on the fundamentals, investors achieve results that elude those consumed by noise and complexity. Age and risk tolerance naturally shape your allocation, but the principles remain constant. Younger investors may hold a higher proportion in stocks to capture growth, while older investors gradually shift toward bonds for stability. Even within these adjustments, the simplicity framework applies. Broad diversification, low costs, regular contributions, and minimal interference. It accommodates individual circumstances while preserving the integrity of the long-term strategy. The framework is flexible yet disciplined, tailored yet universally applicable, a design that allows ordinary investors to outperform without relying on extraordinary skill or foresight. Another powerful aspect is that simplicity reduces mental burden. Investors no longer feel compelled to monitor every headline or analyze every fund report. This mental freedom allows for better decision-making, more consistent application of strategy, and a reduction in anxiety. Investing becomes a predictable, manageable part of life rather than a source of constant stress. This emotional liberation reinforces discipline, creating a positive feedback loop where behavior supports outcomes, and outcomes support confidence and patience. In other words, simplicity not only works mathematically, but it works psychologically. The next dimension of practical clarity is the realization that perfection is unnecessary. There is no perfect allocation, no magical timing, no foolproof formula. The emphasis is on doing the right things consistently, not doing everything perfectly. By owning the market broadly, keeping costs minimal, and maintaining patience, the investor captures most of what the market offers while avoiding its pitfalls. Complexity and precision are seductive illusions. Simplicity is the only proven path to enduring results. This is the quiet wisdom that underpins decades of investor success, the principle that turns ordinary contributions into extraordinary outcomes over time. Finally, simplicity enhances resilience. Life is unpredictable, markets are volatile, and personal circumstances shift. A simple, disciplined framework can withstand shocks, allowing investors to navigate financial crises without panic. By contrast, complex, active strategies often fail precisely when conditions are most challenging. The principle is clear. Simplicity is robust, adaptive, and sustainable. Over decades, it delivers compounding, reduces stress, and aligns human behavior with market realities. In practice, it is both the safest and the most powerful strategy for building long-term wealth. It is not glamorous, but it is effective.